Ladies and gentlemen, good day and welcome to the Poonawalla Fincorp Limited Q3 FY25-26 earnings conference call. We have with us today on the call Mr. Arvind Kapil, Managing Director and Chief Executive Officer, Mr. Sunil Samdani, Executive Director, Mr. Sriram Iyer, Chief Credit and Analytics Officer, Mr. Vikas Pandey, Chief Business Officer, Consumer Business, Mr. V. Raghavan Iyer, Chief Business Officer, Commercial Business, Mr. Harsh Kumar, Chief Human Resources Officer and Head Artificial Intelligence, and other senior management officials. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. Now I hand over the call to Shabnam Zaman, Company Secretary of Poonawalla Fincorp Limited. Thank you, and over to you, ma'am.
Thank you. In line with good corporate governance practices, please note this presentation may contain forward-looking statements regarding the company's future business prospects, strategies, estimates, and profitability. But it is important to note that these statements are based on certain expectations, assumptions, anticipated developments, and are subject to various risks and uncertainties. The actual results may differ significantly from what is stated in these forward-looking statements. Risks and uncertainties related to these statements include fluctuations in earnings, our ability to manage growth, competition, economic condition in India and abroad, changes in law, rules, and regulations relating to any aspect of the company's business, operations, general economic, market and business conditions, attracting and retaining skilled professionals, as well as government policies and actions. Now I would like to hand over to Mr. Arvind Kapil, Managing Director and Chief Executive Officer of the company.
Thanks, Shabnam. Thank you. A very good evening to all of you. I wish all of you and your loved ones a very happy new year. Let me open with industry and economic perspective from our side and the ways we are shaping our organization amid the current sector shifts. India's real GDP grew at 8.2% in Q2 financial year 25-26, up from 7.8% in Q1. CPI inflation progressively softened to 1.33% in December 25 from 4.26 in January. High-frequency indicators signal ongoing economic momentum, with inflation below the lower tolerance band, falling unemployment, and improved exports. Financial conditions, in our assessment, remain supportive amid robust credit to commerce, while demand holds steady and the strong consumption. Let me start with the performance update. I'd like to give a quick update on the Q3 financial year 26 results. Our AUM, as all of you are well aware, is growing at around 77.6% year-on-year, 15.3% quarter-on-quarter, standing at around 55,017 crores as of December 31st, 25. Total disbursements in Q3 financial year 26 grew by 84% year-on-year and 6.5% quarter-on-quarter. Our new product disbursements has reached a monthly run rate of approximately 950 crores in the month of December. New products delivered a 25% quarter-on-quarter disbursement growth, demonstrating the tangible momentum and market pull which our new products are generating at a grassroots level, to give you guys a feel. Yes, the new product contribution to disbursements in Q3 financial year 26 stands at 20% as compared to a 17% in comparison to the previous quarter. Our on-books secured mix stands at around 56%. Net interest margin, including fee and other income, stands at around 8.62% in Q3 financial year 26 versus an 8.4% in Q2 financial year 26. So it's increased by around 22 basis points from quarter 2 to quarter 3. Our GNPA for quarter 3 financial year 26 stands now at 1.51% versus a 1.59% in quarter 2 financial year 26. It's a drop of another 8 basis points here. Our stage 1 assets, which I think is an important indicator for any finance company, rose to 97.4% for quarter 3 financial year 26 as compared to 97.1% in quarter 2 financial year 26. I think this is important from our efficiency improvement point of view, reflecting stronger asset quality and stable borrower performance. This improvement underscores our continued focus on prudent underwriting and effective risk management. Our stated objective is to achieve one of the best-in-class credit cost, which requires a more balanced and mature portfolio mix for which transition is already underway. We've already launched new businesses and they will pick up scale in different proportions over years. Our cost of borrowing has reduced from 8.04% in quarter 1 financial year 26 to 7.65% in quarter 3 financial year 26. That's around 39 basis and 3 quarters. One of the key levers was NCD contribution, which has substantially increased from 7% in March 25 to 27% in September 25 and now approximately to 33% as of December 25, adding strength to long-term capital funding. Our aim is to ensure stable and cost-efficient funding. On AI, out of the total tally of 57 cutting-edge AI projects now we've reached, 30 projects are live. Let me start with how we think about credit cost and ROA, because this, I believe, sits at the heart of how we are building this company. It's important that we are all on the same page. We are designing a high-quality, stable, low-volatile credit portfolio, not accumulating a balance sheet. From an inception, every product we scale is built to deliver sustainable, healthy ROAs on a through-the-cycle basis. Growth is therefore a means to compound intrinsic value, not an objective in itself. Let's understand the role of individual products, their contribution design, higher natural provision impact, and the mathematical average of approximately 12 products and then one business of instant consumer loans, making a total of 13 products. To provide clarity on how total credit costs should be viewed in my assessment, it's very important to recognize that different lending products inherently carry different risk profiles. Instant loans, by design, carries a higher standalone credit cost, while the remaining approximately 12 lending products are more granular, diversified, and comparatively lower risk. We expect credit costs across individual businesses to decline steadily over time, driven by portfolio seasoning, our solid risk calibration, and strong collections. And that's going to be a big focus area for us. At the consolidated level, reported credit cost represents, and this is important, a mathematical weighted average reflecting the proportional contribution of the instant loan business and the combined contribution of the other businesses based on their respective share of assets. Accordingly, portfolio level credit cost is a function of portfolio mix and not driven by any single product in isolation. Accordingly, movements in consolidated credit cost should be viewed as a function of changing composition of the portfolio as different businesses scale at different times. As the portfolio evolves over time, it's important to note products such as gold loans, education loans, salary personal loans, and loans against property are expected to account for 50 to 60% of the portfolio. These businesses have lower inherent risk profiles, lower credit costs, and their growing contribution will lead to a more balanced portfolio in our assessment with growing ROAs and a sustained reduction in overall credit cost. Let me share our perspective on growth, provisioning and accounting optics in the credit context. Reported credit costs includes normal and regulatory provisioning and therefore reflects both realized losses and prudent forward-looking buffers. Management remains focused on continuously improving credit calibration, underwriting discipline, and collection efficiencies across individual lending products, with an objective of strengthening overall portfolio credit performance over time. Improving ROA is a key focus area for the company, and alongside efforts to enhance credit calibration and collection efficiency within individual lending products, management is equally focused on achieving the right product mix to balance risk and returns and the objective of driving sustainable ROA improvement. Sriram will share meaningful insights in early risk indicators across products, which is quite encouraging. Let me cover my perspective on ROAs, which is going to be a key focus area for the company. We reached an ROA of 1.2% this quarter 3. At this junction, let me give you a sense of dispersal yield for quarter 3 financial year 25-26. I think this could be an important metrics. The present dispersal yields pricing of new originations for quarter 3 financial year 26 is approximately 15.5%, reflecting the impact of new product launches and disciplined risk calibration across originations. The new products we have launched have scaled well and are performing in line with our internal expectations. This gives us confidence that growth is now coming from a more diversified and structurally stronger portfolio. On the risk side, credit costs are trending better quarter after quarter. The new credit calibration is behaving well. Early indicators are encouraging and we're seeing improved performance across vintages. As committed, we have increased our disclosure wherein this time we are sharing product level AUMs across products. And I think a very important indicator the risk team is sharing in the investor deck is the 6 MOB early risk indicators, which in my experience is a lead indicator for any finance company in terms of what the new calibration looks like. At the same time, I do believe that operating leverage is beginning to come through. Our operating model is built to deliver structural operating leverage as we scale multiple product distributions, digital platforms, distribution partners, and enhance customer franchise with increasing cross-sell strength, fueling the strength of operating leverage. Putting all this together, healthy disbursement yields, successful product launches, improving credit outcomes, and operating leverage, we believe that the structural levers are firmly in place now. As these trends continue, we see a clear, progressive build-up over the coming periods. On a customer service front, let me share an important perspective. We are launching a next-generation conversational AI platform for omni-channel customer service designed to autonomously resolve 80% of voice and chat interactions, significantly reducing cost to serve while improving customer experience. Only high empathy and exception cases are routed to human agent, driving operational efficiency and scale. Our industry-first contextual agent UI that delivers real-time intelligence, including customer history, loan risk flags, and sentiment analysis, immediate faster resolution, higher first contact closure, and improved compliance. It's important to note the platform is powered by multi-agent AI orchestration and is currently in CUG testing with Hindi and English that will go live by March 26. Subsequently, in phase, we will deploy AI voice agent across 6 regional languages and chatbot in 14 regional languages, unlocking mass market adoption across India, linguistically diverse customer base. This, I believe, in my limited view, should transform our customer service and make it really smart. Now let me talk about a quick sense on the debt strategy. As part of our long-term debt strategy, we endeavor NCDs to be in the range of 30-35% of our total borrowings. We shall keep following the highest standard of governance and transparency with complete sight of the ALCO and the liability management. I shall share some of the key highlights. To give you guys a sense, in line with the guidance provided during our last investor call, we successfully raised over 4,500 crores by way of secured NCDs during quarter 3 as a subset of around 12,330 crores during the 9 months. The share of NCD in our borrowing stands at 33% as of December 31st, with 7% as of March 31st. This increase in NCD borrowing has also contributed to significant diversification of our... Okay, let me just repeat the previous para. It will be our endeavor that AI initiatives will amplify our strength. We've initiated 12 AI projects in quarter 3 financial year 26 across credit, collections, servicing and operations to reduce manual effort, improve decisioning and enable higher volumes without commensurate increases in headcount or expenses. Crucially, this leverage is achieved with disciplined risk management. As a result, we believe our past 18 months well-calibrated AUM growth coupled with present run rates is expected to translate into sustained profitability, driving steady improvements in ROA. And now I'd like to hand over to the Chief Business Officer, Vikas Pandey, and then subsequently, I think, Veerappan Iyer, as to give you a sense on the business updates.
Thank you, Arvind, and good evening to all of you. My name is Vikas Pandey. I'm Chief Business Officer for Consumer Business. Over the past few quarters, our new businesses have scaled meaningfully with constant emphasis on high-quality growth, disciplined execution, and technology-led efficiency. Our prime personal loan business, launched in August 24, continues to gain strong traction. In quarter 3 financial 26, we delivered average monthly disbursements of nearly 430 crore, reflecting growing customer confidence. What is particularly encouraging is the quality of the book. Over 70% of customers have bureau scores above 750, are salaried with category A corporates, and earn net monthly incomes exceeding 75,000 rupees. This validates our risk-calibrated acquisition strategy. Digitally, we continue to raise the bar. 28% of disbursements for prime personal loan in quarter 3 were processed fully straight through, with zero manual intervention, underscoring our focus on scalable, efficient operations. Alongside digital scale-up, we are also strengthening our secured portfolio like gold loan. Our gold loan franchise is expanding rapidly, and we remain well on track with the planned rollout of new year branches during the current financial year. In gold loans, monthly disbursements have nearly doubled from 110 crores in September to 207 crores in December 25, driven by strong branch productivity. 95% of our branches are in Tier 2 and Tier 3 markets, creating high-potential multi-product distribution hubs. Early cross-sell traction from these catchments is very encouraging. Our next product, consumer durable business, continues to scale efficiently, on track to reach 12,000 retail outlets by the year end across 190 plus locations. During the festive month of October 25 alone, we disbursed 118 crore to 54,000 customers, entirely through a seamless digital journey, demonstrating both scale and execution capability. OEM partnerships are expanding across mobile and consumer durable segments, and the TFIN EMI card has seen strong market acceptance, with pre-approved limits and availability across all touch points, and now live on our app and website. The card is becoming a powerful enabler of repeat usage and customer stickiness. Our next product, commercial vehicle business, has delivered average monthly disbursement of 100 crores in quarter 3 financial year 26, representing 35% quarter-on-quarter growth. Used CV financing continues to anchor the business, contributing over 70% of disbursements. We have significantly expanded our channel ecosystem to 700 plus partners, up from 450 last quarter, and now operate across 55 locations with strong momentum in Gujarat, Rajasthan, Tamil Nadu, and Maharashtra. Next product, education loan. In just 9 months since launch, the education loan business has logged 16,000 plus files, supported by a network of 325 plus consultants and partners. By financial year 26 end, we aim to expand our consultant network beyond 500 plus. Our disbursement in the month of December has reached 118 crores. Our instant sanction journey in education loan has crossed 300 sanctions, valued at rupees 150 crores year till date. Now coming to our digital marketing strategy, it continues to evolve toward a diversified ROI-led AI-first model with 5 key focus areas. The first one, deepening our digital partner ecosystem. We now work with 38 plus digital partners, driving 42% quarter-on-quarter growth in disbursements while reducing platform concentration risk. Second, the driving cost efficiency through technology-led innovations. Our paid campaigns have seen efficiencies from near real-time data sharing and will continue to optimize and drive precision with the upcoming server-to-server integrations. Third, we have further improved our website performance through faster load times, better discoverability, and SEO-led enhancements. We have also stepped up our presence off website through content presence across the relevant external platforms. This has driven over 150% quarter-on-quarter growth in our visibility across Google's AI-driven search and discovery results. Fourth, our MarTech stack now embeds AI across own channels, allowing us to run at scale experiments on content, timing, channels to drive better retargeting, superior conversions, lower acquisition costs, and improved customer lifetime value. Fifth and the last, our contextual and AI-enabled brand investments are helping reinforce brand trust and salience, while remaining closely linked to business outcomes. So finally, across businesses, the common thread is very clear: credit first, compliance first approach, disciplined execution, scale with quality, and leverage AI and technology as a force multiplier. We are building platform and portfolios designed not just to grow faster, but to grow better and compound over time. Thank you. And now I hand over to V. Raghavan to give you all a flavor on commercial business.
Good evening, everyone. My name is V. Raghavan Nayyar. I am the CBO for commercial business. The commercial business basket of products consists of loan against property, business loans, loan to professionals, medical equipment loans, machine loans, shopkeeper loans, and mid-market finance. Over the past 18 months, we have built the commercial business around 3 important vectors. The first important vector is people. People are the key to success of any business, and we have meticulously worked on the same to build winning teams across verticals. The second most important vector is distribution. In distribution, we have not only worked to increase our reach into new markets and channels, but also worked to penetrate deeper in existing markets and channels. This we have done by closely working with our channel partners, using our decade-long relationship with them, and by providing them with superior tax and service. Also, we have invested in our in-house direct distribution channel, which would operate mainly out of gold loan branches launched, sourcing all commercial retail products in the catchment areas and locations. The third most important vector is infrastructure. By infrastructure, I mean process infrastructure, policy, and product. We have concentrated on the 3 P's of process, product, and policy, redefined them, re-engineered them for customer delight, bringing in best-in-class stats by leveraging on our digital expertise. By doing this, we have succeeded in growing all commercial products with our risk-first, governance-first approach. Here is a detailed breakup of the commercial business numbers. Commercial business AUM stands approximately at 33,700 crores, exhibiting a very robust growth year-on-year. Our LAP AUM stands at approximately 15,100 crores and is the major contributor to the commercial business AUM. Our unsecured business loan, loan to professionals, and shopkeeper loan AUM stands at approximately 8,000 crores, growing substantially year-on-year. Our medical equipment and machine loan AUM stands at 660 crores. We have now built the base to grow this book aggressively going forward. Our mid-market AUM, which includes NBFC and supply chain finance, stands at approximately 9,400 crores. Approximately 72% of the commercial business AUM is secured in nature. As mentioned earlier, we started our in-house direct distribution channel, sourcing all commercial retail products around 9 months back. And I am happy to announce that this non-DSA channel has started contributing approximately 22% of the overall commercial retail loan disbursements. We are on track to achieve 40 to 50% of the total commercial retail disbursement through the direct channel over a period of time. As the share of the direct channel disbursement increases in the overall mix, it reinforces the strength of the direct distribution non-DSA channel, leading to sustainable profit of the commercial retail products. On the digital front, we are ready and piloting our straight-through digital business loan offering, which will be the first of its kind in the self-employed space. We are also enhancing the product suite in the machine loan and medical equipment business by launching the lease business. Summing it up, we believe that the commercial business has methodically implemented the plans with risk-first and governance-first framework and build the foundation for industry-leading growth in all commercial business products, as the commercial business remains one of the most important vectors in the overall PFL strategy. Thank you. Now I hand it over to Harsh to brief you on digital and AI initiatives.
Thank you, Viragwan. Good evening, everybody. My name is Harsh Kumar. I head Artificial Intelligence. I want to take you through what we are doing in AI. AI continues to be a central enabler of our operating model transformation. In Q3, we advanced our AI initiative focused on lifting productivity, reinforcing governance, and streamlining customer and employee journeys. These actions materially strengthen our ability to scale efficiently and deliver sustained performance as we transition towards a more intelligent and data-driven operating model. We have built a governance framework for all our AI projects, incorporating the 7 sutras as defined by the regulators. This has been adopted to ensure consistency of delivery along with safety and accuracy. To give an update on AI landscape at PSL, I would like to take you through a few of the major projects introduced across the organization in the last quarter. IT development team has taken significant steps to accelerate and optimize the application development lifecycle with the introduction of Build Buddy, an AI-powered assistant acting as a development buddy that aids in writing code and also suggests fixes before code is committed. It does this by providing contextual feedback on logic, performance, and readability, along with automated refactoring. The rollout of Dart Genie, an AI-driven natural language insight engine, empowers internal team to access data insights simply by asking questions in plain language. Currently available with the operations and HR team, this capability reduces dependency on specialist support and accelerates decision-making at scale, with plans to extend its reach to other functions, including customer service and finance too. Within risk team itself, we have delivered an AI-driven solution that aids in post-sanction review for the personal loan product by enabling teams to operationalize a comprehensive risk hindsight process. The system automates document interpretation, field-level validation, and detailed audit logging, materially improving accuracy, reducing manual intervention, and strengthening the discipline of our risk governance. The next step is to extend risk hindsighting framework enabled by AI across broader lending portfolio. To aid our strategic initiative, we have created an AI-powered competition benchmarking engine that on its own searches for changes, analyzes market and competition, and delivers timely insight on pricing and product shifts. By embedding AI into our strategic decision-making, we are not just benchmarking competitors, we are building a future-ready financial organization that leads with insight, agility, and customer centricity. We have our in-house employee support assistant, PyHR, that has been enhanced with additional agent-driven capability. This smarter AI-powered solution executes contextual actions such as instant various employment-related document generation with improved accuracy and intelligence. By introducing autonomous agent-driven workflow, the tool significantly improves employee experience and enables HR team to shift their focus towards strategic initiatives. We have introduced our central KYC AI platform, embedding upfront AI-driven checks into KYC workflow. This brings intelligent upfront validation of KYC data, reducing manual intervention by roughly 15% and materially strengthening both accuracy and turnaround performance. Credit AI, our AI-enabled underwriting support engine, has achieved full adoption in personal loan underwriting, significantly enhancing productivity and enabling underwriters to concentrate on risk judgment over manual processing. We have started scaling this across our broader portfolio, and the upcoming launch of Sati will add a new layer of AI-driven portfolio intelligence. We have also launched a multilingual AI-driven conversational agent that initiates call to prospective customers, screens them on key eligibility parameters, validates interest, captures required data, initiates the loan journey before connecting them to respective teams based on their requirements. This brings more contextual and consistent conversation and improves productivity and conversion rates in key customer acquisition units. This solution is currently implemented for specific business unit with plans to extend the same to other product lines. In conclusion, AI initiatives delivered in Q3 FY 2026 constitute a significant advancement in the organization's ongoing transformation. They enhance the effectiveness of our workforce, reinforce the robustness of our governance framework, and enable a more seamless and intuitive experience for our stakeholders. More importantly, these initiatives further accelerate our long-term vision to become a digitally fluent, data-driven, and highly scalable financial organization, with AI-first approach being adopted across functions. I would like to now hand over to Mr. Shyam Iyer, our Chief Credit and Analytics Officer.
Thank you. Thank you, Harsh. Good evening, everyone. I'm wishing you all compliments of the season. The economic landscape has observed a series of monetary policy adjustments, including cumulative repo cuts of 125 basis points since February, GST2 rationalization and tax reforms highlighting government's aim to support growth and enhance liquidity in the system. Northward movement in the consumer vehicle sales in Q3 FY26 reflects positive movement in domestic demand, resulting in improvement in credit offtake. India's outstanding loans grew at around 11% year-on-year, and positive economic movements favor growth opportunities. Poonawalla Fincorp is aligned to this positive moment and focused towards building a resilient portfolio. Effective orchestration of risk-calibrated framework has supported growth trajectory, ensuring stability and predictability in business performance. Risk, credit, and collections working in synergy are the backbone of a resilient and well-structured portfolio. Focusing on the asset quality, let me give you a glimpse of our key trends. The GNPA has improved to 1.51% in Q3 FY26 versus 1.59% in Q2 FY26. Over the last 4 quarters, there has been a sequential quarter-on-quarter improvement in Stage 1, Stage 2, and Stage 3 composition of assets, which highlights our calibrated approach to portfolio expansion and strengthened debt management practices. Stage 1 composition in Q3 FY26 is at 97.4% versus 97.1% in Q2 FY26. Stage 2 composition in Q2 FY26 is at 1.1% versus 1.3% in Q2 FY26. The Stage 3, the GS3 composition in Q3 FY26 is at 1.51% versus 1.59% in Q2 FY26. The quarterly credit cost has improved to 2.62% for the Q3 FY26 versus 2.67% for Q2 FY26. For all products other than the instant consumer loans, the quarterly credit cost has been a range bound around 1.4% to 1.5% for Q3 FY26. Our endeavor is to be committed to a stated objective to hold best-in-class credit costs in the industry. Let me highlight how we are aligning our credit philosophy into action. The first key aspect being credit by design. We expect a structurally improving asset quality trajectory driven by deliberate choices in product mix and disciplined risk calibration. Portfolio will be focused on products and customer segments that have inherently lower risk and more stable behavioral patterns. Our focus is on salaried low risk asset class. Loan against property book as a portfolio LTV of around 45 to 50% of the market value, providing higher margin against outstanding principal. 70% of our exposures are extended against self-occupied residential or self-occupied commercial properties. 85% of our customer profiles being catered to the segment that has a bureau score of 750 plus. Early risk indicator of 6 MOB 30 plus delinquency ratio for LAP portfolio remains strong at a sub 0.05% level. Gold loans portfolio is built with a skew towards emerging affluent households with strong upward gold rate momentum. Right customer profile selection gives an additional cushion to unforeseen market fluctuations. As of Q3 FY26, there are no accounts that have crossed 30 DPD. Education loan exposures are driven towards students opting for top-tier universities, post-graduation international courses, and wealth-progressive households. Students' credibility, along with backing from strong parental credit history, provides alignment towards financial resilience. Repayment performance is showcasing robust portfolio buildup. Commercial vehicle business offers secured and income-linked finance. 75% of our portfolio is built by used commercial vehicles. 60% of the customer segment is large fleet operators providing long-term stability. As of Q3 FY26, there are no accounts that have crossed 30 DPD. Unsecured personal loans to salaried professionals being built is skewed towards higher bureau score. 70% of our customers have a bureau score of 750 plus. 75% of our portfolio is working with top corporates. The 6 MOB 30 plus delinquency remains range bound at around 0.4%. Instant consumer loan is driven by existing to credit profiles, non-credit hungry, and skewed towards formal credit penetrated cohorts. Given this is a digitally sourced book, the 3 MOB 30 plus delinquency metric serves as a more reliable indicator of digital acquisition quality. We are pleased to report that this metric has shown consistent improvement quarter-on-quarter basis, with a Q3 FY26 reflecting a 70% improvement compared to Q3 FY25. This positive trend underscores the effectiveness of our risk strategies and continued focus on portfolio quality. Consumer durable funding is skewed to existing to credit along with sizable influence of credit diversified borrowers within ETC segment. Right cohort selection in consumer durable business also sets precedents to control and minimize cash funding and fraud risk events prevalent in this product. As CD is a lower tenure book, the early vintage risks are tracked at a 2 MOB 1 plus, which is at 0.15%, and 3 MOB is at 0.06%. This metric has also been showing encouraging trends over the last 3 months. Business loans portfolio growth is driven by customer segments with controlled lender position, credit history over 5 years, controlled unsecured leverage, non-credit hungry profiles with around at least 2 business cycle seasoning. The 6 MOB 30 plus delinquency trends is range bound for around last 2 quarters is 1.15%. Pre-owned car mix is driven towards profiles with controlled recency of exposure built, season credit history for over 5 years plus. The change in the mix of the portfolio has reflected encouraging reduction of 15% in 6 MOB 30 plus performance in Q3 FY26 versus Q2 FY26 and around 30% reduction as compared to the same quarter previous year, Q3 FY25. TFL continues to manage risk in alignment with banking standards as reflected in our 30 plus delinquency levels, which benchmark favorably against peers. There has been a sequential improvement in the 6 MOB 30 plus for the last 4 quarters. The 6 MOB 30 plus for sourcing of Q1 FY26 is 1.34%. This demonstrates the improved quality of a new acquisition. We expect credit costs across each of our individual businesses to decline steadily over the coming years, driven by improved portfolio and disciplined risk calculation, the strong collection efficiency across products. In addition, we have consciously invested in products that have combined high ROA potential with structurally lower credit costs, which will further support improvement as the portfolios mature and their sizes increases. At a consolidated level, reported credit cost represents a mathematically weighted average of our portfolio comprising of 4 business lines and 1 instant loan business. The consolidated figure primarily reflects a portfolio mix, particularly the relative weight of the instant loan portfolio versus the rest of the portfolio. Accordingly, movements in the consolidated credit cost should be viewed as a function of the changing composition of the portfolio as different businesses scale at different rates. Over time, products such as gold loans, education loans, salaried personal loans, and loan against property are expected to contribute an increasingly larger share of the portfolio. These businesses have lower inherent risk profiles and lower credit costs, and their growing contribution will lead to a more balanced portfolio with growing ROAs and a sustained reduction in overall credit costs. Overall, our focus is to build the company on a strong ROAs, and for which we will mix the well-calibrated instant consumer loans with the rest of the products, so the mathematical mix of well-calibrated portfolios builds a stronger value proposition. Second key aspect as we grow the book is calibration, quality, and pace. The calibration drive is focused on optimized cohort selection via multi-source inputs. Information covers is not just limited to existing relationship behavior with PFL. We also look at bureau overall credit exposure history, banking via the account aggregator, GST, salary, and partner data. Augmentation of risk strategy via in-house proprietary models at product and cohort level are used as lever for optimizing risk metrics. Across the model life cycle, from design to development to post-deployment monitoring, the model strength and accuracy is rigorously tested. This is augmented with a real-time through-the-door monitoring to control the expected PD against the set benchmarks. As we speak, the decisions across credit life cycle are supported by 50+ AI/ML models and designed with over 5,000+ feature evaluation. Further, given the portfolio build-up phase, dynamic model calibration with 4 months to 12 months supports the continuous improvement. As I conclude, together, these step-by-step execution across origination, risk containment, and collections is translating into a structurally stronger portfolio. This approach is delivering cleaner incoming cohorts, lower embedded volatility, and sustained improvements in collection efficiency over the cycle. Thank you, and now I hand over to Mr. Sunil Samdani.
Thank you, Sriram, and good evening, everyone. Let me quickly take you all to the financial highlights for the quarter. The asset under management stood at 55,017 crores, representing a growth of 77.6% year-on-year and 15.3% quarter-on-quarter. As part of our debt strategy and projected AUM growth, we continue to diversify our liability book, focusing on long-term borrowings. Hence, the share of long-term borrowings have gone up by about 4% from 80 to 83-84 in an overall borrowing. The share of variable rate borrowing stood at approximately 50%, with another 9% of capital market borrowing with an average tenor of approximately 3 months. The judicious use of short-term borrowing has helped us maintain our cost of borrowing at competitive levels. Our net interest income, including fees and other income, continue to grow healthy, standing at 1,080 crores for Q3 of FY26, which is up 19.3% quarter-on-quarter. This is despite maintaining a healthy share of secured asset book at 56%. The cost of borrowing reduced at 7.65% for the quarter versus 7.69% in Q3 of FY26. This is on account of overall reduction in the interest rate environment in Q3 of FY26. OPEX to the AUM for the quarter was at 4.41%, a reduction of 40 basis points quarter-on-quarter, primarily on account of improved productivity and efficiency. Further, this reduction is despite continuous investments in new businesses and distribution. We have expanded our branch network to 320 branches as on date and increased employee strength to 5,264 as on 31st of December 2025. The pre-provisioning operating profit during the quarter was 528 crores, which represents a 36.5% increase quarter-on-quarter. The asset quality improved quarter-on-quarter with gross NPA at 1.56%, which is an 8 pips reduction quarter-on-quarter, and net NPA reduced to 0.80 against 0.81 previous quarter. Our profit after tax stood at 150 crores for the quarter, representing 102% growth quarter-on-quarter and 702% growth year-on-year. We can now see the benefits of AUM growth and investments in the new businesses coming in. The debt to equity ratio stood at 4.25 times, which gives us headroom for growth. The capital adequacy ratio continues to remain healthy and comfortably above the regulatory requirement at 18.17%, of which the Tier 1 capital is at 17.15%. The liquidity coverage ratio at 156 as on December 31st, 2025 is well above the regulatory requirement of 100%. On the liquidity front, we remain comfortable at a surplus liquidity of 6,488 crores as of December 31st, 2025. Thank you. Happy New Year. And I would now like to open the floor for question and answer sessions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Chintan Shah with ICICI Securities. Please go ahead.
Thank you for the opportunity and congratulations on the strong set of numbers and crossing the 1% ROA mark. My first question is on the asset quality. So if I look at the provision coverage ratio for stage 1, stage 2 as well as stage 3, it has been coming off since the last 4 quarters. Since December 24, the stage 3 PCR is almost down 10% to 48 now versus 57. Even the stage 1 and 2 PCR combined is now less than a percentage versus 2.8% a year ago. So considering that 44% of our book is currently still unsecured, so where do we see this number settling at a on a steady state basis? That's the first question.
Yeah, hi. This is Sriram here. It's as I said, there is a change in the product mix, and if you see your stage 1 book has increased from 97.1 to 97.4, and if you look at even prior to 4 quarters, it was close to around 95 point something. So we are seeing that the stage 1 asset itself has increased. So in terms of the overall stage 1, another important point to note here is the stage 3 book has also reduced from 1.59 to 1.51. That kind of explains the reduction in the PCR, right? Also, we'll have to note that the reduction in the PCR is also on account of the rundown of the old STPL, which had a higher provisioning. So, as the product mix changes, and then you have low risk kind of assets, the ECL also kind of changes accordingly, and that's the reason your PCR is lower.
Sure. So in terms of a steady state, so something around 50% PCR on stage 3 could be considered from a 1 or 2 year perspective?
I can't comment on that because each product, as the mix changes and we start scaling up, we may look at a time horizon is something which we'll have to look at, and based on which the provisionings will be made.
But I think on the calibration, let me just add, Chintan, that we've this time disclosed very precise, I think if I'm not mistaken, a year and a half approximately, 6 quarters of data for 6 MOB, which will give very good insight into how we are underwriting and what's the bureau-based information in terms of the quality on our entire book. I think that could be very, very, other than stage 1, that's another very strong, first time we've disclosed, that should give you a complete insight and confidence into the solid credit calibration underwriting that we have been speaking about.
Sure. And so, if you could just help me with the write-off policy for our unsecured products, what would be the write-off policy on that?
180 DPD.
So over all the products, whether a secured, unsecured?
Yeah, so unsecured is 180 DPD. Vehicle secured is 365 DPD. Yeah, and even loan against property is 730 DPD, which actually is case-to-case basis across industry.
Sure. And just one more thing on this 294 branches and currently 320, I think, which we mentioned. So apart from gold loan, what all products would we be currently offering? So what's the plan there? Just wanted to understand there. Yeah.
No, I think our branches that we are talking about are focused. Our gold loan branches are going to be fairly die-hard gold loan branches. That's the plan right now, and that's what I had mentioned last time. We are a very focused product on the branches. There will be some benefit of cross-sell, but I think it's going to be a very gold gold kind of branch, which is focused.
Understood. And so on the new disbursement, which is like 20% of the overall disbursement.
Normal cross-sell might happen, but directionally, it's a very focused gold loan branch for us. Sorry. Yeah, you were asking a question.
Oh, no, sorry. Got it. So basically, dedicated gold loan, but some other benefit from cross-sell, then we won't deny that.
It's not like others cases won't happen, but we are a focused branch is designed for gold loan. That's all a limited point. Yeah. Sorry. Over to your question. Okay.
Sure, sir. Understood, sir. And sir, so on the disbursement from the new products, which was currently around 20% for the quarter and 11% of the AUM. So any ballpark targets here? So what kind of percentage in the overall AUM mix are we looking for the new products, say, by the time we reach 1 lakh crore of AUM?
I think, the plan of these new products they're well calibrated. They're servicing a very distinct objective. Personal loan is a very salaried. We're getting fantastic. We're very happy with the way it's building up. Acceptability of corporates. You heard that it's high quality asset. If you look at consumer durable, we're investing behind a customer franchise. If you look at commercial vehicles, it's picked up very good momentum. If you look at gold, I think it's continuously quarter building up fantastic. So objective is going to be, we will keep investing behind these businesses to increasing. But remember, bulk of the heavy lifting investing has been done. And I think it'll be probably fair to say that operating leverage will start kicking in now. And that was the whole original plan. So we had said that the first 18 months, we would be probably biased to a little more AUM and investments. I think all that heavy lifting done, you started to see probably operating leverage started to kick, and you can start seeing the sparks now in terms of probably robust profits. You can start smelling that, and I think we are very excited from here on.
So thank you for patiently answering all the questions. I have more, but I'll fall back in the queue. Thank you and all the very best. Yeah, thank you.
Thank you. Ladies and gentlemen, you are requested to limit your questions to 2 per participants. The next question comes from the line of Abhijit Debriwal with Motilal Oswal. Please go ahead.
Yeah, good evening and thank you for taking my question. So first question is on the gold loan and CD business. What we heard.
Your voice is not audible. You'll have to be slightly louder. Yeah, I can't hear you.
Is it better now?
Yeah, better now. Please.
Yeah. So the first question I had was on the gold loan and the CD business. What I heard during the opening remarks is we have crossed 300 gold loan branches. But when I see our presence, it is predominantly the Western India, Gujarat, Haryana, Rajasthan, Maharashtra. So if you could just help us understand, is the idea to first capture the Western, Central and Northern part of the country and then eventually go to South India? The others are more dominant. And consumer durable also, I kind of heard that 90% of our dealer presence is somewhere in tier 2, tier 3 cities. So what is the playbook which will be there in CD as well?
I could hear your full questions, but gold loans, I think if you're asking effective quarter 3, I think we should be in the range of approximately 190, 192, somewhere there. But all the LOIs, identification, all that has been done, and the remaining branches, we should be on track in this quarter. And we should be in a position to build a very solid franchise. Like I said earlier, with a focus on gold. Gold is giving us good yields, good asset class, and it's in line with plan. On consumer durable, whatever little I could hear, and please correct me and add to the question, whatever I understood you said, what's the momentum feel on tier 2, tier 3 cities? I think if I'm not mistaken, we already had close to 10,000 plus outlets. And our strategy is mix of consumer durable, and because, we've got as a company strong strength on unsecured digital, we don't need additional manpower. We are finding that experiment started as an experiment probably. Now, along with consumer durable, we could be the first company that our resources are not only doing consumer durable, but digitally. We have a certain proportion of origination which is coming with the same team on unsecured digital loans, and very successfully so. And remember, just to give you a sense, the consumer durable might have an average ticket size of, let's say, 28,000 approximately. But an unsecured loan in throughput could be 4.5 to 6 lakhs. So the throughput and productivity of the team with the yields, even at the point of origination, not at cross-sell, we could be the first company to successfully pull it off. That itself gives us a huge advantage on the consumer durable reach and the business model being more robust. They're a conventional, pure, only consumer durable model of the same team. I hope I'm able to get across. Right.
Got it, sir. And is my line better now? I'm sorry you could not hear me earlier.
In between, Trivalji, your voice goes clear and then suddenly we can't hear you. Something like that, but please go ahead. I can hear you clearly.
Okay. Sorry about that. So that answers my question. The only other follow-up I had on gold loans was, right now I've seen the branch presence is predominantly in Western India. Is that the thought process to first capture Western India, Central and Northern India, and then move to the Southern India?
So we are going to be, actually we have covered already Gujarat, we are, Maharashtra, Rajasthan. We are going, state by state, because gold loan is a product where you have to have a supervisory depth because we are opening branches. So the next geography which we are picking up now is Karnataka and some part of Odisha. So that is how we will, spread our branches.
But the whole idea is that if you don't want to just spread yourself in gold, it's important. We've done this business in the past. Very important to have density pockets with supervisory depths, because one of the biggest advantages and risk is you need very solid controls when it comes to gold branches. You'll appreciate that. So that's the background.
Got it. And then the second question I had was on credit costs. Just trying to understand, while I think again during the opening remarks I kind of picked up that barring instant loans which have higher credit costs, most other products are showing range-bound credit costs of about 1.4 to 1.5%. So I have two subparts to this question, Arvind sir. First thing is, whatever credit costs that we are seeing right now, are they all attributable to the newer and the existing products that we earlier had? So this has nothing to do with any accelerated write-offs which you have called out in the presentation. These are all business as usual credit costs, right? This 2.6% credit cost that you're seeing right now?
No, I think, let me explain that point again. It's very nice of you to raise it again. I think the point that I and Sriram are highlighting is that whether it's instant loans, whether it's the remaining 12 products, all individual credit costs are showing constant improvement so far. That's point number one. I think the limited point we wanted to share with you that as part of our designs to optimize, when you look at our credit costs, you must keep in mind that you should treat it as, in simplistic term, a mathematical average of instant loan consumer loans and the remaining 12 products. So while explaining, I said instant loans relatively by design is higher yield, higher credit costs, whereas the others are normal yields and normal credit costs, more as a reference point. But I think the larger point I wanted to say is that when you look at our credit costs, look at two important things. It's a mathematical mix of the 12 products and instant loans. So that let's say if the contribution is 15, 18 or 20, because individually all products might actually land up reducing in our credit costs. And we could have a great opportunity for ROA built up. So it's a very limited point just to understand. Also looking at our growth rate, please remember as NBFCs you have a higher natural provisioning. So that also component, if you grow at a higher rate, becomes part of your total credit cost. So it's just sensitizing the total picture. That's about it.
Got it. And when we say the credit costs will reduce in the coming quarters and years, the primary driver is going to be the improvement in product mix in favor of gold loans, LAP, education loans, right? Rather than the seasoning of these products, because once they season, maybe the credit cost will start inching up. So the primary driver is going to be primarily the improvement in product mix.
No, let me repeat again. All 13 products with seasoning are expected, and calibration and strong collections are, in our assessment, expected to constantly improve every quarter. That's point number one. Point number two, it's in our hands. How do I mix it for respective total credit cost to optimize the ROAs of the company, as from here on, ROAs will become an important thing. So let's say, for example, hypothetically saying, you have an X product at a credit cost of, hypothetically, let's say, 2%. And you have another credit cost at, let's say, 3%. Now, either you take 50-50 and have a credit cost total, or you can have a 60-40 and do it. Similarly, when you have a mix of approximately 12 to 13 businesses, all we are saying is that the mix will be optimized. So you actually might land up with quarters going, the 2% might become 1.8 and the 3% might become 2.8. But the mix could be in such a manner which could reflect a total credit cost that you actually might land up making very healthy ROAs, despite individually improving thanks to collections, thanks to product seasoning, and our credit calibration. That's why I said you must check our 6 MOB. Because Thiruvalji, if you check our 6 MOB, you'll get the pulse. Not only is the stage 1 improving, which is one part of the story. Not only the GNPA improving, that's another part of the story. But if you see carefully, 6 MOB normally in any banking or finance business is a very solid indicator of what is the quality of calibration that you're doing across the portfolio. And you'll get a first-hand sense of how individual products will be fairly solid.
Got it, also. This is very useful, and thank you so much for your enhanced disclosures in this quarter. And lastly, this board approval for 5,500 crores of fresh equity issuance in this quarter. We plan to consummate it this quarter or after the end of this fiscal year? Hello, am I audible?
Slightly louder, sir.
Yes, sir. So just last thing I was asking, today we have taken board approval for raising 5,500 crores of fresh equity. We plan to consummate it this quarter or after the end of this fiscal year? Okay, sir. Then maybe I'll come back in the question queue. Thank you.
Thank you. The next question.
Are you talking about the capital raise, if I get you right? If you are, then I think we've taken a 12 months approval, enabling approval, but I think you're well aware of our growth rates.
Thank you, sir. The next question comes from the line of Nischint Chawathe with Kotak Institutional Equities. Please go ahead.
Am I audible?
Yes, sir, you're audible. Please go ahead.
Okay. No, I just want to double check, if the management line is connected.
Yes, sir, they're connected. Go ahead with your question.
Sure. So, across these 13 products, how do you think, about the duration of the book, let's say across short, medium, and long tenors? How are you really kind of thinking about balancing this? And in that sense, is there a little bit of a scope to play the yield curve? I believe you have increased the duration of the liabilities in the last 2-3 quarters.
Duration of the liability.
Yeah. So on the asset side, first of all, how are you thinking about, contribution of short, medium, and long tenors? And, what could be, are you kind of, targeting a particular, average duration of the book? And in that sense, how are you placed on the liability side?
Yeah. So see, across these 13 products, these are into different tenor buckets, right from, say, ultra long term, something like loan against property, to consumer durable, which is ultra short term. So I think the products are now there in every space, of duration which we want to be. And like Arvind articulated, we look at how these products, ramp up, and which gives us, better risk-adjusted return. So basis that, I think we are pretty fine, with the duration, being 6 months here and there, because we have a well-diversified liability profile and have the capability to raise money in every single tenor bucket on the liability side. So, and right now also, if you look at our ALM, it is positive across each of the buckets except that 3 to 5 years, which anyway with the capital raise, would be taken care. So, I think that's fine. So we are flexible, on the duration. So that's no specific.
What is the current duration of the book on the asset side?
Current duration of the asset, would be somewhere between 2.5 to 3 years. 3 years. Yeah.
Okay. And does it kind of change, maybe in a year or so when, the contribution of your product goes up? Or is this a kind of...
While it may not change dramatically, but like I said, it will depend on the evolution of each of the products and the way they scale up. So this is that, but I think we are pretty broad.
It should be there.
Yeah. We'll take care of it. I think whichever way it goes. Yeah.
Thank you. The next question comes from the line of Kaitav Shah with Anand Rathi. Please go ahead.
Yeah, thank you so much for taking my question. Am I audible?
Yes, you're audible.
Yes, sir. First of all, congratulations, good quarter, and thank you so much for the increased disclosure. I think they're pretty useful. So my question is more on the operating leverage. I think you already pointed out that we've seen signs of improved operating leverage. And do you think this trend can continue, or there is still some investments that are left to be done at an overall aggregate level, which can keep the cost-to-income ratio popped up?
So I think, see, the very fact our design had, to be honest, a lot of investments, strategic investments, which we did over this financial year. And if you ask me, the trade-off is in complete favor of operating leverage. So not that you won't make incremental sales teams and not that you won't have new branches. You'll have a certain proportion of that investments which are going on, but I think it's hugely in favor of operating leverage from now on. And I would term this as we would be excited from here on the operating leverage side.
Additionally, the OPEX in percentage terms.
OPEX, yeah. But then we've said every year, directionally it should. And I think you mentioned cost to income, and I think probably it will be heartening to see similar trends there as well as the years go by.
So, got it. So, second question was on the AUM growth front. Of course, we have been far ahead of our long-term aspirations. Do you think near-term we would like to raise our guidance on the growth aspect, especially next year? Or we would still like to stick to what we...
Can I just speak a little louder if you don't mind? I can hear you, but in between I'm not able to figure out what you're saying.
Okay. Sir, on the growth front, would you like to reiterate the target, because we've been growing slightly higher than our long-term averages. So near-term, will we continue to grow higher, given that the new products are firing much better than expected?
See, our focus is going to be completely biased to the retail products, the full bouquet of retail products, especially the new ones. And but I think our broad guidance of 35 to 40% is what I like to say is a good guidance. There could be some moments where we may have had much better than that, but I would probably hold that broad approach directionally to be 35 to 40 is what I would like in today's economy. Yeah.
Thank you. Ladies and gentlemen, this will be our last question, It's from the line of Agam with Agam Investments. Please go ahead.
Thanks for the opportunity. It's a quick question on the credit cost. So credit cost of this quarter was around 2.62%, right? So going ahead, what can be this number? As you said, the number will go down. So what should one look at it?
Sorry to interrupt. Mr. Agam, could you please repeat your question again?
I can't hear you, sir. Sir, I can't hear you.
Yeah. Am I audible now?
Yeah, better.
Yeah. I'm saying the credit cost for this quarter, and so going ahead, as you said, it will go down. What can it be? Any thoughts or color on that?
We are not giving any forward guidance, but we kind of, as the contribution of the new products such as gold loans, education loan, PL Prime, and all of the new products keep growing and gain full-scale participation in the product basket, the share of the credit-calibrated instant book will be normalized at a lower level, and this will have a favorable bias on the overall credit cost.
Okay. Just the last question. On the first part, I think maybe I missed the voice. Can you repeat, what is it? So we have taken the element for 12 months. What is the timeline realistically we are looking to close since we are growing at much faster pace?
Sure. Yeah. So we'll basically look at the way the growth pans out from here on, and basis date which we will do the capital raise. So we don't have a specific timing in mind, right?
I think, the part is that we've taken the approval gives us the strategic flexibility now. Yeah. And it's in our control, and we are well on top of it. I think that's a limited point. And we are, there's no particular guidance we are giving on the timelines.
Thank you, sir. Ladies and gentlemen, that was the last question for today. With that, we conclude today's conference call. On behalf of Poonawalla Fincorp Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.